After 10 years of trading Forex, these are my 3 favorite ways to enter and exit the market for high win rate trades. These are my personal methods. I use them all the time when I trade. Let's jump right in. Okay, so let's take a look at the first example. It's for a reversal trade. Typically, traders would be looking for a selling opportunity once we break market structure. In this case, the support. The most logical approach to this would be to simply aim for the previous area low, which is around here. However, as we can see, the market straight away drops towards the downside, breaking past our previous area support. And the problem is that we have nowhere to aim for now on the 4-hour time frame. If we just look past the previous data, there's no clear area of support. So the best thing you can do in this case is head over to the daily time frame to see whether we can spot an area of support. So now we're on the daily. We can see the market structure we had on the 4-hour time frame, and we can clearly identify now an area of supported level that was previously respected by the market candlesticks. As we can see, each time the market has touched this previous area level, it went towards the upside. So coming back to the 4-hour time frame, we have marked our daily area of support, and we will now add a indicator called the stochastic RSI. And as we expected, the RSI indicator is telling us that the market has been oversold. Furthermore, this one candlestick over here has moved around 75 pips in a small duration. This is the 4-hour time frame, so in 4 hours it managed to move 75 pips, where it usually moves, as we can see from the market structure, around 50 to 40 pips. And since we had that significant breakout, we should be expecting a retracement back to our previous area of sensitivity that we previously wanted to aim for. So when you try to enter a reversal trade, make sure to have realistic expectations of the trade. For example, you wouldn't want to target areas that are simply out of your reach just because it gives you a good risk to reward ratio. That's not how it works. You want to target areas that you can see. So somewhere over here seems pretty decent, around 30 to 40 pips profit should do. Or you can use moving averages like 20 and 50 to ideally find a place where they cross their resistance. So if we wanted to enter for a buy just over here, we still have space till the moving averages. So potentially we could target for around 50 to 60 pips in this case. So this is like a junction you see on the street, right? There's a lot of traffic over here, and that's why there's going to be likely a lot of sell orders, or you should at least expect a lot of sellers entering and exiting trades in around that area level. So for this trade, ideally, if I would do it, I would probably go with 50 pips. I believe that's pretty good, and stop loss around 25 pips, just covering our daily area of support. Now let's see if we are correct. The market does continue moving towards the upside. Also, another thing to mention is a bad risk reward doesn't necessarily mean a bad trade. If the market candlesticks are sitting on a strong area of support or resistance, basically a key level that has previously been respected multiple times, this could signal a high probability trading opportunity for a quick entry and exit cash out type of deal. For example, if we only took 20 pips instead of 50, it still doesn't matter. It's still a couple of $100 in your bank account. Of course, the trade could fall. Of course, you can get kicked out of the market. However, if the probability of the trade is 80%, your risk to reward ratio is still mitigated just because you're losing 25 pips, but the probability or the chance of turnaround for the trade to go up is around 80%. You're still more favorable move is towards the upside to target, around 20-30 pips. This is the way I trade crypto, by the way. So strategy number 2, how to enter and exit trades, is trend continuation. So the best way to identify a trade opportunity is by using moving averages 20, 50 and 200, understanding market momentum and volatility, and finding important candlestick patterns. Okay, let's take a look over here. The market has been trending towards the upside, right? We had higher highs, higher lows, higher highs, higher lows. Every single time market has been moving towards the upside, and every time it moves, it pushes towards the upside just a little bit higher. And as we can see, after it broke out the 200 moving average marked in green, we had a sharp burst of bullish power towards the upside. Now, it could have been the news, or it could have been Batman for all I care about. I don't know. However, what I do know is we need a retracement back. So adding a RSI indicator, we can see that the market has been over bought. Furthermore, we can see nice two shooting stars or pin bar candlesticks, likely signifying a reversal, dropping back down. So you could potentially enter this trade for a reversal trade that we learned earlier on. However, we are talking about trade continuation, not a reversal. So after the market completes its push exhaustion push cycle, we can then identify another trade opportunity. Just take a look at what happened recently. We had a bullish engulfing candlestick just over here. This is our candlestick pattern confirmation. What's another confirmation for the trade? That's right, we actually have crossed the two moving averages. Look, the 50 is over here, the 20 is over here, and the candlesticks are at the top. This means that likely there's going to be a bullish push towards the upside. As we can see previously, the candlesticks failed to break the 20 moving average. Every single time they tried, they failed and even pushed further down before meeting the 200 period moving average, which is the strongest one out of them three, and then it pushed the market further up. So with this information, we have clear direction bias for our trade to enter the market. We want to be covering our 20 and 50 moving averages, so that's around, I don't know, 56 pips, and we want to be aiming for the previous area of resistance. So simply put it, just the area top over here seems reasonable. So what we can do, target the profit around 100 pips, I would say, seems pretty damn reasonable. This gives us a risk to reward ratio of 1.76. So we're risking $100 and we could get 176 back. The reason I'm not covering the 200 moving average with my stop loss is because the buy orders have already been triggered once the candlesticks touched over here. So the train has already left and there is a new destination. And likely this destination over here won't hold because the moving averages have already been crossed. So the next level to aim for is of course the very top, and this is where we can exit the trade for profitable trading gains. So let's just see whether I'm correct. Oh wow, look at that, you just pushed towards the upside heavily. This method of entering and exiting trade is definitely my favorite. I made a ton of money throughout the years using this. Try it out. Okay, strategy number 3 for entering and exiting trades is utilizing chart patterns. And I'm not talking about the cinnamon swirl pattern, although it would be pretty cool. I'm actually talking about the double top, double bottom, or for all the beginners out there, the M and W pattern. Simply because it looks like a M, and vice versa, if you're trading, it'll look like a W. The double top pattern is amazing because it consists of two tops. Wow. Great information. But what's also important is the neckline. If the candlesticks manage to break the neckline, it means the chart pattern has been confirmed, which increases the likelihood of trade success. So let's just take a look at this trade example. After the neckline has been broken, we should probably enter the trade. However, that is not the best way to do it. We need to wait for a rejection. And as we can see, the rejection happens and it starts some bullish power. Now, this can be terrifying if you enter the trade straight away. That's why we want to enter on a candlestick confirmation like the bearish engulfing candlestick. We can short this position straight away, and we also have a better risk to reward ratio. Our stop loss has to cover the double top itself. You can use the line tool just like that. As we can see, stop loss is slightly higher just in case the market pushes towards the upside for any reason. You got it covered. So we have our stop loss level, we know where to enter the trade. Where do we exit? We simply want to measure the double top and the neckline and add it where the break actually happened. So as we can see, 73 pips, the breakout happened just over here. This can be our target profit level. So around 96 pips in this case gives us 1.59 risk to reward ratio. So again, for every $100 we are risking, 159 in this case would be the gain. And the funny thing for me is the chart pattern is literally aiming for the previous area of support anyway. So this double confirms that this trade will likely go towards the downside and retest the previous area of structure. So now if we take a closer look, the market dips down nicely and actually reaches our target profit level as expected. Once the price level reaches the double top take profit level that we got, we can safely exit our trading position just around here and bank ourselves a lot of money. I love using chart patterns. I've been using them for decades, and for anyone saying they don't work, they clearly lack trading experience. So if you want to learn more about Forex trading, how I trade, you can join my Telegram group. We've been smashing the markets, or you can simply watch this video next.